Welcome to the Nichols Tax Update Podcast, issue 21-11 for March 15th, 2021. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and comments by real experts on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking action on any item discussed in the program. I also must acknowledge every time we do this program the value of my subscription to Tax Notes Today, published by tax analysts, the preeminent publisher of current, helpful, relevant information about United States tax law, the tax laws of the 50 states, and now adding significant coverage of international tax law. I can't imagine trying to function as a tax professional without my subscription to Tax Notes Today. Well, enough of that puffery. What's in this edition? 5 topics. If you've been with me a while, you know that's an average week. No tax-exempt status for a student loan forgiveness lottery. We'll talk more about that. Intuit has hit a brick wall in its attempt to shuffle complaining taxpayers off in a kind of a no real cost settlement. They deceived these taxpayers with their free file option, at least that is what's alleged, and a federal judge is having none of a soft settlement. He's going to hold Intuit's feet to the fire, and if they don't do this, then they're faced with thousands of expensive arbitrations. We'll talk some more about that. A sheriff's sale does not extinguish tax liens. We've talked about that in this program before. I want to re-emphasize it. When you buy property at a sheriff's sale, you need to get a legal opinion so that if the wheels come off the wagon, you go back on the lawyer's professional liability insurance for the value of what you paid for the property and anything that you paid to improve it. We'll talk about the risks of doing that. And a government lawyer failed to file a 1040 when he was in private practice. What happened? Well, stay tuned. And then a couple of provisions of the American Rescue Plan Act of 2021, which got a lot of publicity, but doesn't really affect the filing of your 2020 federal income tax returns very much. Now, they have been affected by the CARES Act and by the Tax Cuts and Jobs Act and that proliferation of legislation over the past, I guess, the past 18 months. So you do need to be current on what the rules are for the 2020 return. But the American Rescue Plan Act of 2021 did not change those rules very much. Here we go. This organization, excuse me, is denied tax-exempt status. Letter ruling 2021-09008. No 501c3 status for an organization established to help students with their student loan debt by operating a student loan lottery. We could get millions of students to put in a minimum deposit and then draw numbers, and some students would get their student loans forgiven. The IRS concluded that organization does not serve a public purpose. Instead, it serves a private purpose, the interest of the student loan debts that would be paid off. It is legal, by the way, for federal credit unions to operate prize-linked savings account lotteries, but that doesn't mean you can morph that into a debt forgiveness lottery for student loans. Here's what the IRS said. A substantial part of your activities serves the private interests of private persons whose student debt would be repaid. That makes sense. And the presence of a single substantial non-exempt private purpose will preclude exemption. So no 501c3 exemption, although it seems to be very popular. Everyone wants their own tax-exempt entity. For most, it's a complete waste of time and whatever fees they pay accountants and lawyers to help set it up, because you're going to get turned down. Now, Intuit's attempt to settle on the cheap, a class action lawsuit, has met resistance from a federal judge. In Michelle Arena versus Intuit, a district court judge up in Northern California said, "Not so fast." He was presented with a proposed class action settlement of claims by thousands of taxpayers who claimed to have been tricked by Intuit into believing they were getting free filing service for their Forms 1040, only to find that they were diverted into a for-pay service and they couldn't file their return until they paid sometimes as much as $105. The settlement, according to the judge, did not provide enough money. Intuit was willing to give free services, but a lot of these people wanted nothing else to do with Intuit. They just wanted money, and this settlement did not provide enough money for members of the class who were damaged, and the opt-out procedures unduly burdened class members. So Intuit continues to face thousands of expensive individual arbitrations, so they should be in the mood to settle. Federal tax liens survive a sheriff's sale, an auction, open auction. The buyer bought this land at an open outcry auction. They paid the liens off, or the proceeds of the auction paid the liens. They thought they were entitled to clear title. They built a building for about $240,000 on part of this land that was sold at this sheriff's sale, and they were distressed to learn that they didn't have clear title. Federal tax liens for a corporation's unpaid employment taxes and the penalties continue to encumber property that was sold in a sheriff's sale for unpaid property taxes. You paid the property taxes, and so you got the county's lien cleared, but you did not get the IRS lien cleared. The buyer, by the way, paid the amount of all those tax liabilities, but because they didn't get proper notice, the IRS did not get the money. And so the liens were not paid off. My advice here is get a written legal opinion on the title to real property that is acquired in any kind of a transaction. Make sure you've got a lawyer's and some title insurance in the deal with you, so you don't get trapped in something like this, having spent $240,000 to build a building and then find out that you don't have clear title to the land. You still owe the IRS some money to clear the title. Could a Department of Justice attorney face jail time for failure to file? Back in 2017, he was working as an attorney in a private firm, made over $100,000 in that year, and he and his wife failed to file a return. Time forward, 2018, 2019, 2020, he still hasn't filed a return, but it occurred to him that he might want to file when he started getting funny colored mail from the Internal Revenue Service. Now, he's working for the government by now. He's got a job with the Department of Justice. He eventually filed the return, but that elapsed time, over 2 years, almost 3 years, and not filing until the IRS really had him virtually in its clutches is evidence of intent not to file. It wasn't an error. It wasn't an oversight. You were never going to file that return, Robert. So the maximum penalty, by the way, is not more than 1 year in prison, a $25,000 fine, or both, and he still owes the unpaid tax, the penalties, and the interest. What a shame. A promising career as a government lawyer down the chute because he didn't file his tax returns on time. So here we have H.R. 1319, the American Rescue Plan Act of 2021. All the hype, all the publicity, the first major legislation of the Biden administration. Bring it on. Lots of changes, but they're effective in tax years beginning after TYBA 12/31/20. They're effective for this year, 2021. Only 3 effective on the date of enactment, DOE, and 2 effective for TYBA 12/31/19. Let's talk about those 2 first, because those are the ones that are going to affect your 2020 returns. There is no federal income tax on the first $10,200 per recipient of unemployment compensation for taxpayers with adjusted gross income below $150,000. There will be a lot of relatively low-income taxpayers receiving unemployment compensation benefits who will benefit from that provision. Then there is a temporary modification of the limitations on the reconciliation of tax credits for coverage under a qualified health plan with advance payments of that credit. The temporary modification of the limitations is that the limitations are increased for advance payments of the qualified health plan tax credit. Now, what about those three that are effective on date of enactment? Well, those don't have so much to do with your tax return as they have to do with other benefits, but not usually part of this program, and I've not felt it was necessary to track the benefit payments and such, because it has nothing to do really with your tax liability. But because the American Rescue Plan was touted as a tax act, effective on the date of enactment, which was earlier this week, 2021 rebates to individuals are based on either the 2019 or the 2020 AGI. If you have not filed the 2020 return yet, the IRS will base the rebate on your 2019 income. $1,400 for each individual. If you're a single individual, you start to phase out above $75,000, and you're fully phased out at $80,000. $2,800 for married filing joint, which, by the way, requires 2 Social Security numbers, and that phases out at exactly twice the phase out for single individuals. $1,400 per dependent, but each dependent requires a Social Security number as well, and of course would be filed on the parent's return as a dependent. And then there is extension and modification of credits for paid sick and family leave, and that was already the subject of an IRS bulletin attempting to give some relief. Preserving health benefits for workers. Health benefits are extended by H.R. 1319, and credits for paid sick leave and family leave are extended as well, in each case by until the end of 2021. The expiration date on both of those is 2021. Everything else is effective for 2021, with sunsets as early as 12/31/21, but most commonly 12/31/2025. That is the most common sunset. Well, folks, until next time, please remember to stay safe. We need all of us to be here next week.